Welcome back to FX Street. It's 9 a.m. Eastern. Today is Wednesday, November 14th, 2012. Welcome back, one and all. Great that you could join us. My name's Adam Rosen. Very happy that you could be here today. We have a very fun topic, as always, to talk about today. Today, what we're going to do is find the strongest currency pair, the best currency pair to trade. The best currency pair is the currency pair that has the strongest trend, strongest directional trend in the market. You can take a look at something, and by the way, if you can't see the charts at any time, please let me know, or if my voice cuts out. Here's the Euro Aussie. This has actually been surprisingly a very interesting pair over the past couple months. A very big uptrend this past August started down near 116, and by late September we're at 128, at 1,200 pips to the upside. And then starting late September, early October, we started to move to the downside, which I believe we're still in that long-term trend to the downside. 128 over the past month has moved down to 121, so about 1,600, about 1,200 pips to the upside and 700 to the downside so far. A trend in the currency market emerges when the two currencies in the pair are moving in opposite directions. You take a look at something like the Euro Swissy. Where's the Euro Swissy over here? Now, Euro Swissy, for obvious reasons, does not have any kind of trend at all. Lost my Euro Swissy chart here. Here's a new one. So the Euro Swissy obviously is not moving because the Swiss National Bank has embarked on a massive amount of intervention where they're buying Euro Swissy to prevent the Euro Swissy from going back below 120. This is the Euro Swissy daily charts. This is 120. That's what the Euro Swissy looks like, because both currencies are basically behaving in the same fashion. Now, in the old days, we would say, to find a currency pair with a strong trend, you want to find a currency pair where both currencies in the pair respond differently to the same macroeconomic kind of conditions. Meaning, when the stock market goes up, we tend to buy the high-yielding currencies like the Aussie and the Kiwi and sell the low-yielding currencies like the yen. So the Aussie yen, Aussie dollar, Kiwi yen, Kiwi dollar, those kind of currency pairs where there's a large difference in interest rates as well, that's also called a carry trade, the difference in interest rates between the two currencies in the pair, those tend to be trending currency pairs. Now, you take a currency pair where both currencies are very similar in nature, they respond in the same way, or they're from the same geographic, sort of economic, political point of view, then you tend to have a range-bound currency pair. Something like the Euro Swissy, Euro Pound, Pound Swissy, Aussie Kiwi, Aussie CAD sometimes, Dollar CAD sometimes. So though that was the old days of looking at currency pairs. I still think that holds true, but we want to be able to better quantify exactly if a currency pair has a trend and which currency pair has the best trend. So we've come up with a pretty interesting way. We've done this a few times here at FX Street, and it's kind of fun. It takes just a few minutes. What we're going to do is use the RSI indicator on daily charts, standard settings. Okay? We're going to take a look at each one of the yen crosses. The yen crosses are the easiest to use because the yen currency is the second currency in every pair. Euro yen, pound yen, Aussie yen, etc. And you can do this with any currency pair or any currency. We can compare all the dollar crosses. The euro dollar, the pound dollar, the Aussie dollar, Kiwi dollar. Problem is, when you use the dollar crosses, we have to contend with the dollar Swissy, dollar yen, dollar CAD. In those pairs, the dollar is the first currency in the pair, so we have to invert our calculations. It's not a big deal, but the yen crosses are just easier. So what we're going to do is go down the list, and we're going to take a look at the euro yen. Again, daily chart, RSI. All we're going to do, and you should see here RSI, all we're going to do is make note of the current position of the RSI. So you just hover the mouse over it, and it gives us, the euro yen gives us a level of 50. And you can see how fast. This takes a little longer because I'm talking, but if you just go through the process very quickly, it's actually very fast. Pound yen, 50 as well. Next on the list, Aussie yen. RSI, 61.63, will round to 62. Aussie yen, 62. Kiwi yen, RSI, 50 as well. And this is going to tell something very interesting about the market overall. Whoops, Kiwi yen, it's supposed to be 50, not 5. Okay. CAD yen, 51. CAD yen, 51. Dollar yen. Dollar yen, 61. Very, very interesting. 61. And I believe, last but not least, is the Swiss yen. 8 currencies, should be 7 pairs. Swiss yen, 53. Swiss yen, 60. What did I say? 63? 53, sorry. Makes a difference. Okay. Now, first off, what you'll notice is that despite the fact that we're using daily charts, which do differ, because they do reflect different trends, the RSIs are all very, very close. Euro yen, pound yen, Kiwi yen, CAD yen are all basically at 50. CAD yen's at 51. Swiss yen's at 53. There's been times that we do this, so we run through this exercise, and you'll see some RSIs at 70, some RSIs at 30, some RSIs at 20. They're usually a lot more spread out than they are here. This tells us something about the state of the Forex market. It tells us that most of the currencies are very, very close together. There's not a big difference between Kiwi yen. There's almost no difference between Kiwi yen, pound yen, euro yen. Now, look, if Kiwi yen and Aussie yen were close, that would tell us, well, the commodity-based currencies are close. The high-yielding currencies are close. But the fact that the Aussie yen and the euro yen, that the euro yen and the Kiwi yen are very close. They're both at 50 with an RSI. That's very unusual because the euro has very low interest rates. Kiwi has relatively high interest rates. The Eurozone tends to, they don't benefit when commodity prices go up because they consume a lot of commodities. New Zealand produces a lot of commodities, so their economies are sort of on opposite sides of the coin. You should not see the euro yen and Kiwi yen close together in terms of RSI. Now, what does this tell us when the euro yen is 50? Okay, well, it's 50 is not a good way because it's 50-50. Let's take the dollar yen. Okay, so here, let's type this in here. Okay, when the dollar yen, JPY, RSI equals 61, this means the dollar RSI equals 61 and the yen RSI equals 39. How did I get the number 39? It's 100 because RSI is in scale 0 to 100. So it's 100 minus 61 equals 39. So everybody get that? That's all the calculations that we need to know for this exercise. Because when we look at the RSI, or if we look at any technical indicator at all, if we're looking at the RSI in Apple stock, it's easy. The RSI in Apple stock is 52. That means Apple stock is 52, the relative strength. If the relative strength is a little bit above 50, it means it's a little stronger than average. 50 is average. Below 50, a little bit weaker than the average. When we look at a currency pair, we always have to assume that we're looking at the first currency in the pair. It's actually the first currency compared to the second. first currency divided by the second. But for our purposes, just consider the first. So when you look at the RSI of the dollar yen, and the RSI of the dollar yen is 61, we can extrapolate from that the dollar RSI, the relative strength of the dollar is 61, the relative strength of the yen is everything else in 100, 100 minus 61, which is 39. So now what we're going to do is put these in order. From strongest to weakest. And by the way, how do we view the yen? Well, with the euro yen and the pound yen at 50, it's easy. Because the euro and the yen are exactly the same, have exactly the same RSI, have exactly the same relative strength. When we look at the dollar yen, and the RSI and the dollar yen currency pair is 61, it means the dollar is a little bit stronger than the yen. We always have to assume that the second currency in the pair, well, it's the complement. That's in mathematics. It's a complement. Means 100 minus whatever that number is. But that if the RSI of the currency pair is more than 50, then the second currency in the pair is weaker. Because that other currency would be below 50. Anyway, we'll go through the list and I'll show you what I mean. So we went through the RSI of the different yen crosses. Euro yen 50, pound yen 50, Aussie yen 62. What's the strongest here? We would say the Aussie. After 62 comes the dollar, which is 61. After 61, which is the dollar, we look to CAD, which is 51. And then we have a lot of currencies all at the same spot here, which is, whoops, no, wait, 1 second. 53 is a Swissy. Then the CAD at 51. Okay, so far, Aussie, dollar, Swiss, CAD, in that order from strongest to weakest. And then we have a lot of currencies at the bottom of the list, including the euro, pound, Kiwi. We'll put this in parentheses because they're all basically the same. And don't forget about the yen. Now the yen is we say the yen is 50. Because if the CAD yen is 51, it means the CAD is a little bit stronger than the yen. We could actually say that the yen, because the euro yen, the pound yen, Kiwi yen are all at 50, the yen is actually the same strength. I'll step back and do it again. I'll explain this again. I don't want to confuse anyone. We're looking at the RSIs from strongest to weakest. The strongest number, the highest number is the Aussie yen, because it's 62. The next one is a dollar at 61. The next one after that is the Swiss yen at 53. The next one is a CAD yen at 51. Now, the euro yen, pound yen, Kiwi yen currency pairs all have an RSI of almost exactly 50. It's actually 50.2, 50.1 if you really wanted to, look for the exact strength and weakness. You could look to the decimal, but I think rounding it to large round figures enough. And that tells us that the euro, pound, and Kiwi are all basically have the same relative strength, and they all have the same relative strength as the yen because they're 50. If the euro yen was at 51, the euro would be 51, the yen would be 49. But because they're all at 50, we put them all together. With that said, now we take, to find the strongest currency pair, match the strongest currency against the weakest currency. Okay, so the strongest currency is Aussie. Weakest, we have a choice. Euro, pound, Euro, pound, Kiwi, yen. So the currency pairs with the strongest trend include Euro, Aussie, Pound, Aussie, matching everything against the Aussie, everything in the parentheses, the weakest currencies. Aussie Kiwi, Aussie Yen. Let's go back to those charts now. RSI. So we want to confirm it. We take a look at the actual currency pair that was suggested by our exercise. Euro Aussie, what's the RSI? Remember, when we did the experiment before, we looked at a lot of all the RSIs are basically between 50 to 62. Now take a look at the Euro Aussie, 33.59, which is 34. Euro Aussie equals 34. We have the Pound Aussie. Again, everything is daily charts here. Pound Aussie, 32. Pound Aussie, 32. Aussie Kiwi, I think I have it somewhere here. $68. Now it doesn't matter if it's strong or weak, as long as it's away from the center. And Aussie Yen. $62. Well, we know that already. Aussie Yen equals 62. So we can actually even, furthermore, find a currency pair that's the furthest away from 50. The Euro Aussie is at 34. And that's 16 points away from 50. 50 minus 16 is 34. The Pound Aussie is 32. That's 18 points away from 50. 50 is the center. If it's at the center, it means there's no trend. It means the first currency pair, the first currency and the second currency in the pair are moving in the same direction. What we're looking for is a currency pair where the two currencies moving in opposite directions, which forces the RSI to either go up or down. The Aussie Kiwi is at 18, which is 18 points above 50. The Pound Aussie is 18 points below 50. The Aussie Yen is at 62, which is 12 points above 50, so not as much. So we actually see, going through the exercise, we've identified 4 currency pairs with very strong trends. Euro Aussie, Pound Aussie, Aussie Kiwi, Aussie Yen. Aussie being the strongest and the Euro Pound Kiwi Yen being the weakest. This is based on our daily charts. You may ask, well, what if I go through this exercise on short-term charts or longer-term charts? Then we're going to get different indications, but there's a huge benefit in doing so because it allows us to develop an opinion about the market in layers. To say, well, based on the daily charts, that's what we know so far. We can run through this exercise based on different time frames as well. Let's go to monthly charts. Does everybody understand so far? Try to do my best to keep things clear. Monthly charts. Okay? Euro, Yen. And by the way, before I get started, when we know, the benefit to us is that when we know a currency pair that has a strong trend, like the Pound Aussie, then we look for trades only in the same direction as a long-term trend, which in this case is the downside, because it's most likely to continue in that general direction. When you have a currency pair that's arranged on markets, I understand the idea about buy low, sell high, but you basically have a 50-50 chance of being right if you buy low, or if you buy or sell in a range on market, because a range on market, it doesn't have a clear direction. It's kind of like you're in the ocean and, there's no clear trend in terms of the wind. And, so the boat's rocking to the left and rocking to the right and, it's more or less you're staying where you are in the middle. And if the boat moves a little bit to the left, you can anticipate it'll then rock to the right, but, that's not really a consistent way to predict the future, which is, as traders, that's what we're trying to do. If I want to predict the future in the pound Aussie, if I want to see, not predict the future, but if I want to find the trade with the highest probabilities of success, you take a look at the pound Aussie, go back 10 candlesticks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Over the past 10 candlesticks, 1, 2, 3, 4, 5. 5 have been red and 5 have been green, but if you look at them, the red candlesticks have definitely been a lot more dominant than the green candlesticks. If you had sold shorts the pound Aussie at any random spot on the chart over the past 10 candlesticks, I think you would have had a better chance of making money. If you had bought, you would have had a better chance of losing money. Another way, if you were to sell on the open and buy in the close, anticipating that the market was going to go down, well, this candlestick hardly moved. This we would have lost a little bit of money because we sold on the open and we bought on the close, which means we would have sold at near the bottom but and closed near the top, but that's a very small candlestick. If we would have sold here at the open and bought at the close of the day, daily charts, then we would have made quite a bit of money. Same thing with this. This we would have lost a little bit. This we would have lost even a little bit more. Then we would have made a lot more on the down candlesticks. Point being is that when we're trading in the same direction as the trend, we don't have to be exactly right as long as we have the trend, the wind in our back, the wind in our sails, so to speak, that we're trading in the same direction as that trend. Let's go to the monthly charts now to really get the big picture of the direction of the currency pair. So monthly charts, the euro-yen, you can see differences in the indications now. Euro-yen has an RSI of 44, monthly charts. Pound-yen, RSI, 47. Pound, GBP, JPY, 47. Aussie, RSI, monthly charts, 52. Kiwi, monthly charts, 52. Notice how the Aussie and the Kiwi are almost exactly in the same position on the monthly charts. CAD yen, monthly charts, 49. Dollar yen, 47. Finally, Swiss yen, 48. Put these in order. Strongest to weakest based on monthly charts. Okay. Euro yen's at 44 pounds. 47. Divergence. It shows us that these range-bound markets have been quite persistent. But there's a little bit more divergence. Okay, so the strongest to weakest, Aussie, Kiwi, at 52. 52 now. Then the CAD at 49. Then the Swiss at 48. Then the dollar at 47. Dollar, the pound also 47. I'll put these in parentheses if they're exactly the same. And the euro at 44. But remember, we also have to contend with the yen. Where's the yen? We know that the Aussie and Kiwi is 52, so the Aussie and Kiwi are a little bit stronger than the yen. We know the CAD's at 49, so the CAD's a little bit weaker than the yen. So the yen fits right in the middle between the stronger and the weaker. Aussie and Kiwi are a little bit stronger. CAD's a little bit weaker. Aussie and Kiwi at 52, CAD's at 49, Yen is at 50, right in the middle. That's based on monthly chart. It should be 8 currencies there. Strongest are the Aussie and the Kiwi, tied at 52. Then the Yen, then the CAD Swiss, then the dollar and the pound, which are tied at 47, I believe, yeah. The Euro's the weakest. Now we match the strongest and weakest currencies together to find the strongest trending pair. So, what's the strongest? The Aussie. What's the weakest? The Euro. Put that together. Euro, Aussie. Put the strongest, which is a Kiwi, against the weakest, which is a Euro, and we have Euro, Kiwi. Very, very interesting. Remember when we did this, we went through this exercise based on daily charts. The Euro Aussie had the strongest trend. Well, the Euro Aussie, ironically, has one of the strongest trends even on monthly charts. Here's a Euro Aussie RSI, 38. Euro Aussie, 38. And then we have the Euro Kiwi, which I know I have that right over here. Monthly charts. RSI. $38.75, we'll call it 39. Euro Kiwi equals 39. So the Euro Aussie really is the strongest trending currency pair of any currency pair that we have. And by the way, take a look at the monthly chart of the Euro Kiwi. I mean, this represents, we hit the high, I know this goes back to 2009, but even more recently, this is the beginning of 2012, which is right here. Let's go back to a daily chart. There we go. So this line represents the beginning of the year. Now we had some moves to the upside, and then we had a very, very big move down. We had a move to the upside, and then it looks like we're kind of going down now. It kind of looks like a head and shoulders pattern here as well. And you can also extrapolate. We have trend lines we could look for as well, as follows. There's no doubt the direction of the market. Now, fundamentally, how can we explain this? Well, you have interest rates that are much higher in the Eurozone than, much higher in New Zealand than they are in the Eurozone. That's number one. Let's talk about this for a second. Fundamentally. Because it's always kind of interesting to see if we can justify these trends. And the trend, even if I can't justify it, I still have to honor it because the trend is there for a reason. This represents trillions and trillions of dollars flowing slowly and quickly out of the Euro into the Kiwi, out of the Euro into the Aussie for very specific, real, concrete reasons. There's no accident, there's no mistake why this is happening. It's not just sort of, it's just kind of happening because, it happens. It's, we tend to think that sometimes, I used to think that at least in the stock market, well, sometimes stock, who knows why stocks move. Sometimes it could be, because mutual funds are buying it because the stock pays a dividend. Sometimes it's because hedge funds are buying the stock because they think it's undervalued, or maybe because they think that it's a merger acquisition target. So, but in the currency market, in the Forex market, and this is the largest market in the world, you take all the other stock markets and bond markets and real estate markets, you put it all together, that is the Forex market. The Forex market is all the money in the world. Even if money is in gold, you have to convert your money into dollars to buy gold or British pounds to buy gold, depending on, the availability of the commodity in your particular country. So when you see trends that develop, there's no accident, there's no mistake. And the question is, how often should we do this on the daily charts with this exercise? It's not even something, if I were to say do it once on a daily basis, you might not even have to do it every single day. Personally, I have a different way of going about doing this exercise, so I'm constantly aware of the relative strength, but you want to try to always make sure you're on the right side of the trend. Now, if you're using the daily charts, it's not going to change so quickly unless something drastic happens in both currencies in the pair. Because remember, we're looking at the Euro-Kiwi. In order for the Euro-Kiwi to change trend, it not only means that the Euro has to go up, it means the Kiwi has to go down. If something drastic has happened, over time, as you run through this exercise, you'll begin to get a feel for how often you should reference the charts. If you looked at the charts once a day, I don't even think that would be necessary. Maybe even once a week, at the beginning of the week, or maybe once at the end of the week, to see what has developed. Maybe once on Monday and once on Friday to see if any currencies have switched positions. It would be kind of interesting to keep track of that. But from a fundamental point of view, how could we describe the Euro-Kiwi trend to the downside? Well, number one, we look at the carry trade, which is the difference in interest rates. The Kiwi pays much higher interest rates than the Eurozone does. Number two, we could say commodity producer versus commodity consumer. Now, New Zealand is a commodity producer. They're responsible for a lot of, I like to call them soft commodities, wheat and corn, food commodities. Eurozone obviously consumes a lot more commodities than they produce. So as the price of commodities go up, that will tend to benefit New Zealand, and it'll tend to not hurt Eurozone, but they're definitely not going to benefit as food prices go up. Same thing in the U.S. as well. Now, think about it for a second. What do we see, just stepping back from a more fundamental point of view, what do we see happening over the past couple of years as one nation after another gets into trouble? And the central bank lowers interest rates down to zero, and that economy is still in trouble. What have we seen? Quantitative easing. Quantitative easing, and we talk about this a lot during our fundamental discussions, is where the central bank, like the Federal Reserve or the European Central Bank, they'll print an enormous amount of new money to buy long-term bonds, to buy mortgage-backed securities, to do whatever they're going to do. But from our point of view, what's important is that it has a dilutive effect to the dollar. When the Federal Reserve has printed all this new money, there's more money in circulation out there. The Federal Reserve injects newly printed money, brand new money into the economy, so that hopefully buyers will have more, consumers will have more money to consume with, and that producers and business owners will have more customers, or at least your customers will have a greater amount of buying power. So each one of our dollars has a little bit less comparative value. That's why gasoline prices go up. That's why food prices go up, because the average box of cereal, it has that many more consumers with that much more money trying to buy that same box of cereal because of quantitative easing. And right now we have quantitative easing in the U.S. We're currently in the third round of quantitative easing, plus Operation Twist, plus about a dozen other stimulus programs. We have a bond buyback program in the Eurozone, specifically Spain and I believe Italy, as well as stimulative operations going on in Greece. We have an enormous quantitative easing program, an asset purchase program in the UK. We have quantitative easing in Japan. Bank of Japan has quantitative easing. They really recently extended, I think it's around 11 trillion yen now, is their quantitative easing program. Ironically, it's not necessarily quantitative easing, but we have the Swiss National Bank buying their own currency. Buying the euro and selling their own currency. When they sell their own currency, it's pushing down the Swiss franc the same way that quantitative easing is pushing down the US dollar. So you could say that they have their own hybrid version of quantitative easing. What three currencies did we not mention? What three currencies do not have quantitative easing? Aussie, Kiwi, CAD. Why? They're all commodity-based economies. So as we have quantitative easing in the U.S. and quantitative easing in the Eurozone and the U.K. and Japan and Switzerland, I think that's it, right? Those 5 different countries, or 5 different nations, economies, that tends to benefit the commodity producers. That's why they do not need QE and Aussie Kiwi CAD. We're helping Aussie Kiwi CAD already. Those of us in the U.S. and the Eurozone and everywhere else where there is quantitative easing. We're basically, collectively, printing new money that's going to go out there and afford to buy more crude oil from Canada, more gold and metals from Australia, and more corn and wheat from New Zealand. There's no surprise why they don't need quantitative easing. We are the quantitative easing. So, just kind of funny how that works. Now, you go back and you take a look at, going through our exercise, what are the currency pairs with the strongest trends? Remember, a currency pair with a strong trend is made of 2 currencies that react in different ways to the same economic conditions. With the same economic conditions around the world, massive amounts of quantitative easing. It's designed to benefit the Eurozone, but it's actually helping more Aussie Kiwi CAD. So when you put a euro currency or a let me back up. If you put a currency, if you take a currency that is creating quantitative easing and pair it against a currency that benefits from quantitative easing, then you have euro Kiwi, euro Aussie. You could even say euro CAD. Now, it didn't come up on our list, but remember, we only looked at the absolute strongest and weakest. Euro CAD did not qualify on those grounds, but I'm guessing it's not that far away. Here's a monthly chart. It already looks interesting. Insert indicators, put in the RSI. EuroCAD RSI is 41. Remember, when you go through these exercises, that's on a monthly chart, on a daily chart, EuroCAD 48. Okay, so daily chart, we've come back a bit. But go back to the monthly chart, you could still argue, seen a pretty significant move in the EuroCAD. Going back to 2009. We're at 171. Now 127. That's a 5,000 pip drop. I know that a lot of currency pairs have moved 5,000 pips in the past couple of years, but it certainly is significant. It's not as significant as the Euro Aussie or Euro Kiwi, but there's definitely a relationship between the two. I think that Canada is probably a little bit of a hybrid in between being a commodity producer and one of a currency, I would say, on our side of the table, our meaning U.S., Euro, UK, meaning capital investment, the opposite of a commodity producer. Very simply because, while Canada does produce oil, it represents a segment of their economy. It doesn't represent all of their economy. They also have a housing market, which is really hurt. They're also very close trading partners with the U.S. And when the U.S. consumers cannot consume Canada's products, then Canadian producers suffer as well. So Canada is a little bit of a hybrid. It's not a pure play, as they would say. It's not a pure play in terms of being a commodity producer. It's a little bit of both. That's why I find it funny that, sometimes traders will say, well, oil is up today, I should go long the CAD. So, well, it depends how much oil is up. If oil is up a little, it's like saying, with Apple computer, well, a lot of people are buying iPods. That means I should go long Apple stock. You say, well, iPods, that represents a portion of what Apple does to make money. They also have, the laptops and the desktops and the iPhones and the iPads and the accessories and iTunes, and it's a diversified business. Canada is also a diversified business. It's not just oil. There's a lot involved. Australia, it's a lot more focused towards mining. New Zealand, farming. Now, we looked at let's try to take an example here. When we ran through this exercise, in fact, let's do this. Let's go back to the Euro Aussie. Okay. So in terms of the Euro Aussie, I want to talk for a second about time frames. The monthly RSI equals 38. Daily equals, and just go to a daily chart, 34. 4 hour equals 57. 57. The 1 hour, 76. And I wouldn't recommend it, but let's even go to a 5-minute chart. Well, 5 minutes too short term. Let's try 15-minute. 82. 15-minute equals 82. What does this tell us? And by the way, I like to use, when we are looking at charts, I like when the math is symmetrical, meaning a 15-minute chart, 4 times 15 is a 1 hour chart. 4 times a 1 hour chart is a 4 hour chart. And you could say 4 times, well, it's not 4 times, it's really 3 times 4 hour chart is a daily chart, but 4 times the daily chart, well, no, it'd be 30 times, it's a monthly. Though we go to weekly and, okay. But I guess forget it. Okay, so anyway, I thought I had a point there, but then the math didn't make sense. But at least, when we look at a 15-minute chart to a 1 hour chart, it's a factor of 4. From a 1 hour chart to a 4 hour chart, it's a factor of 4. So I like how you sort of you go up from a factor of 4 with every time you go the time frame going down. At any rate, which trend is most significant? The RSI indicator measures relative strength over the past 14 candlesticks. If you look at 14 candlesticks on the 15-minute chart, you're looking at the past 3.5 hours. 14 15-minute charts, 15-minute candlesticks. If you look at the daily chart, it's 14 days, 14 daily candles. Obviously, the longest term time frame is, and I spelled monthly wrong, but the monthly RSI is 38. And it goes back 14 months. So we're going back over a year. Go back to the monthly chart. This goes back a little more than a year. We can count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. That's what the RSI is looking at right now. And then we could always even change the RSI to go further back, more than 14 candlesticks or less. I always like to use a standard setting, so I don't think it's necessary to start to change the actual settings of the RSI, as long as whatever approach we use is the same. But the point being is that when we look at the RSI, monthly RSI is 38. It tells us something. It tells us that the relative strength on the monthly chart is 38 for a reason. Over the past 14 months, the euro has fallen, has been weaker than the Aussie. Now you take a look at the daily RSI at 34. The daily is 34. The monthly is 38. So the daily is a little bit weaker than the monthly is. So on average, comparing the daily to the monthly, is the Euro Aussie outperforming its average or underperforming its average? I would argue it's underperforming its average. The easiest way to equate this is to go back to sports. Go back to a baseball player. Baseball player, if you take a look at the back of the baseball card, it'll give you that player's career average. In baseball, if you hit 300, that's considered to be a very good baseball player. 300 in baseball means for every 10 at-bats, 30% of the time you're going to get a hit. And actually, baseball is considered really good. You can fail the most in baseball and still be very successful. Now, when a player is going through a slump, they'll say, well, the analysts and the sports radio guys will say, well, don't worry, that baseball player more or less is going to hit to the back of his baseball card, which means by the end of the year, statistically, he's probably going to come back to his career average because it's his career average. And when that baseball player is going through an incredible hot streak, that player may start to get nervous because he knows that eventually he's going to go through a slump that'll pull him back towards his career average. Think of the monthly RSI as the career average. That's the career average for the Euro Aussie, 38. On the daily, based on the daily candlesticks, it's 34. So the Euro Aussie is, not exactly hitting to his average. It's a little bit below. So we know for a long-term trade, I wouldn't necessarily buy the Euro Aussie, but it's not a bad idea to take profits. Because we know over the long term, the Euro Aussie has an average RSI of 38, and when the daily is below it, and we would place a trade based on the daily chart, we're below the average, which means statistically that 34 eventually will come back up to 38. Of course, if the Euro Aussie really starts to go down, then the 38 will decline as well. But then again, the daily RSI will decline faster because it's going to count the most recent candlesticks. Now, compare the daily to the 4-hour. The daily RSI is 34. Over the past 14 days, the Euro Aussie has been very weak. Go to a daily chart. Here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 here. Over the past 14 days, daily chart Euro Aussie, we have an RSI of 34. That's the career average now. But based on the 4-hour RSI, we actually have a 57, which means this is the average, but over the past 4 hours, that's a 4-hour candlestick right here. Go back 14 candlesticks. We've actually this is atypical. This is not typical for what we would normally expect the Euro Aussie, how the Euro Aussie to behave. So what does this tell us? Number one, I always want to trade in the same direction as the trend. I mean, that is the number one. That's the most important reason why I went through this entire exercise to begin with. Identify the strongest trend and find a trade in the same direction as the long-term trend. Euro Aussie has the strongest trend in the Forex markets. We should make our best effort to only trade in the same direction, which means sell short the Euro Aussie. Use a shorter time frame to look for the entry when it's above its career average. Take profits when it's below its career average. I'm out of time. I apologize for running late here. If you have any questions, you can contact me directly, www.forex.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see your calendar because we have a lot more ahead of us really quickly. But a 14-period RSI did not take into account varying movements. Coming in relation to ours to take long to show up, hence potential factor. This is true. This is true. Take profits when it's below its average, when the trade's moving in our favor. Enter when it's moving short-term, countered long-term. Contact me there if you have any further questions, or please see FX Street's webinar because we'll be back on with much more. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Street.